Okay, so we're going to shift gears a little bit. I introduced myself as an accountant, right? So I'm going to cover a little bit about the regulatory reporting, the upcoming regulatory reporting. Maybe some of you are interested in knowing more about it. Many of you might have heard about it, probably wondering whether it's going to impact your day-to-day affairs or not, right? So based on implementation experience of IFRS 17 in the region, I'm going to share some information about what it is and what are the best practices, what needs to be done as a first step, etc. Right? So 17 compliance, people might be wondering that it can be very daunting, because if you look at it as a departmental issue of only actuaries or maybe only the finance department, of course it definitely will be much more daunting. And not only that, if you underestimate the impact of the standard, because there's quite a lot of interpretation that may have to be done, subject to interpretation. So you can configure it in multiple different ways and end up having very varied results, right? So underestimating that. And then if you think that this is something like another reporting that has been asked for, and so can we do it yourself, DIY, okay, then using Excel or anything, then that's going to be another big challenge where you should not be thinking like that, otherwise it will be very daunting. And then if you neglect the data due diligence, because a lot of data would have to be compiled and collated and needs to be reconciled and matched before you take in for any computation of IFRS 17, right? And if you think that this is okay, let's do it once and probably repeat the process many times over, no, because there will be a lot of validation checks, a lot of eligibility checks, especially for general insurers, a lot of onerosity tests that needs to be done on an ongoing basis, right? So you cannot take that approach as well, otherwise it will be daunting. And then if you don't see this as an opportunity to streamline your reporting, overall reporting, because you will continue to have your 4 reporting, your continued existing reporting. You will also have your tax reporting continuation, okay, and also your BAP reporting and PD reporting plus your new IFRS 17. So you will have multiple reportings in place, right? So if you don't see this as an opportunity to streamline, okay, the entire process, of course, it can be really daunting. So let's go through basics first. I'm sure many of you already know about this. I may be preaching to the choir, but what it is, this IFRS 17 is trying to bring in a lot of transparency, comparability within the insurers as well as outside the insurance industry as well, so that the reporting becomes much more standardized, not just a recognition of income based on internal policies alone, right? So the standard definitely is going to be applicable for all insurers moving forward. We have seen it in rest of the world. And newer calculations in terms of premium allocation or GMM, BBA or BFA, all these methods are going to be inside. Some tests would have to be done in terms of onerosity, eligibility testing for general insurers. I like the way in talking in India, because I can speak as fast as I can and people can understand. Now, please raise your hand if you cannot understand my speed, okay? And in terms of new disclosures, of course, there will be a lot of disclosure reporting where you're supposed to be time valuing the money, which is not a new concept for life insurers, but of course for general insurers, there will be some changes where if you're underwriting more than 1 year contracts, which is a very normal case for general insurers these days, you could be 70% or 75% insuring 1 year contracts, but there could be 20 to 30%, which could be on a slightly longer term, which you are in doubt in terms of whether it's going to be PAA or GMM. You have to justify, right? So those things would come in place. And also, in terms of the timeline, of course, we have seen different timelines in different countries, okay? Many of our customers have already gone live in 23 itself, 24 some countries, expecting India to be from 1st of April 2026, right? So although it is not mandated, but of course, that's the way things are moving. Just a bit of information about who we are. Wolters Kluwer is an information services providing company. We deal with a lot of regulatory reporting, tax reporting, and IFRS reporting. Across the globe, more than 1 million accountants use our solution from a tax perspective. We do provide healthcare solutions in terms of keeping health records, okay? Tech, the division that which I belong to, which is called CPESG. We have more than 2,000 customers around the world using our solutions for corporate performance management, okay? Financials, of course, we do plow in at least 10% of our revenue into R&D to improve, constantly improve. From an insurance industry perspective, we have done Solvency II before, a long time ago, about close to 10 years now. We've also done IFRS 16, we've done IFRS 17, we're also doing global minimum tax. So specialized on regulatory reporting solutions from a DNA perspective, because our platform is meant for creating purpose-built applications to address purposed requirements. So we do provide financial consolidation, planning, budgeting, forecasting, as well as regulatory reporting, as I said, 16, 17, ESG reporting, okay. So it'll be easy for you to connect all these reporting if, let's say, if you're not looking at it in isolation, right? And available on cloud as well as on premise. So that's just to give a brief background of who we are, right? In terms of experience in IFRS 17, right, specifically, we have done implementations globally as well as in Asia Pacific, where the mandate was sooner than India, right? We have more than 40 plus customers where we have implemented IFRS 17 and including general as well as life insurers. One such is in Netherlands, okay, who took our Solvency II as well as our IFRS 17 as a follow-up because they saw that this is much more expert-driven solution, right? I'm not going to bore you with all these videos, but just to boast, saying that yeah, we have done this 17 reporting quite a number of times, okay, and I'm going to share some best practices among that, right? Tucumarin, of course, this is also in Malaysia, general insurance. Yes, they also took this for the simplicity of the complexity of the IFRS 17 solution, right? So 150 plus insurance companies have been using our solution, and 40 plus in the region itself, and I mean, I personally have overseen about 20 of the implementations in the region, right? So based on that, let's get into the 17 reporting, right? It can look very simple, where you just have to collect data from multiple sources, including actuarial systems, okay? Where you just do the BA, the building block, which includes the computation of LFRC based on the blocks of present value of future cash flows, okay? Plus the risk adjustment, right? Plus the, the CSM. And then accreting the CSM over a period of time. So, I mean, technically, you're just calculating the contractual service margin based on future cash flows and then accreting it over a period of time, right? Simply put. Same way as how you recognize your income in any other business. Meaning, if you are doing long-term projects, right? As an accountant, if you see multi-year projects, needs to be accounted in such a way that you recognize the income based on production or based on the milestones, right? There are multiple criteria for different industries. Same way, this standard mandates accreting the income based on the predicted future cash flows. When I say predicted future cash flows, you have to have cash flows nominal values, right? For, if it is a life insurance, of course, for the entire tenure of the policy, and then predict the expenses or claims, right? And also, if there are liabilities that needs to be paid at different points in time, then liability for incurred claims may have to be discounted. So net is just an accounting way of present valuing the future income and expenses at the current moment, and also accreting income based on that. Now, when we say accreting income, of course, there could be a lot of challenges in this, because challenges for different types of insurers, right? Life insurers probably has a system of records, probably has an actuarial system where they have 70, 80 years of premium that is already present in the source systems, in your actuarial systems, right? And loss ratios and patterns being predicted, and expenses being predicted, claims being predicted, right? Life insurers may have a system which is able to predict the cash flows, okay? So from a life insurance perspective, the challenges, I'll go to the general later, grouping of the cash flow, because these systems probably would have been implemented 5-10 years ago, where IFRS 17 was not present at that point in time. Now, grouping the contracts based on the IFRS 17 way may pose a challenge, though they may have the cash flow data, though they may have discounted cash flow also, because this concept of IFRS 17 is about discounting, right? So the challenges are very specific there, where grouping of contracts can be a challenge, and calculating the reinsurance income in terms of non-distinct investment components, or even directly participating products where you have to compute the variable fee, right? So integrating the directly participating IFRS 9 into the IFRS 17 to reflect the correct liability, right, is a challenge, right? And also the dilemma of extending the current actuarial system, which probably would have implemented 5-10 years ago. Can we extend that actuarial system to do IFRS 17, right? So, but at that point in time, probably IFRS 17 was not there, so the actuarial system may not be scalable or ready to handle IFRS 17. But if you may think, okay, I mean, data is coming anyway from actuarial system, why not I just extend, right, the current actuarial system? Not all data is coming from actuarial systems. There are a lot of data that has to come from GL, a lot of finance related information. Unfortunately, the word F is finance, right? It's not actuarial accounting system, right? So you have to have a lot of financial intelligence, right? So the dilemma of extending the IFRS 17 from the existing actuarial system is predominant in life insurance. Whereas, I mean, many of our customers, the life insurance customers who have taken our system on top of their existing actuarial system. It makes sense for them because it was difficult for them to extend, right? Of course, data volumes and policies are going to be very high. General insurers have got different challenges. They may not have long years of data to be projected, okay, unless they have, this projects and engineering constructions kind of insurance that has been taken. However, they have to prove that they're eligible for PAA. I'm sure, you would have read about what is PAA. This morning also, there was a mention about PAA being simpler. Of course, if you are a general insurer following only 1 year contracts, 100% of your policies, okay, and all your contracts are profitable, not onerous, okay, then the change is very minimal for you. But following this condition is very difficult. I'm sure not all your contracts are profitable. Some are definitely onerous. So which means you will have to do eligibility testing, okay. So it poses a little bit of a different challenge for them to be on their toes every year to make it simpler. For that, most of our customers, what they've taken is, they have taken an approach of a hybrid. So let's not take a chance. 1 year contracts, we will follow PAA. Anything above 1 year, we will not even question, we will follow GMM method. GMM requires more data to be collected, more data to be projected, etc., right, to be on the safe side. Some general insurers have taken the approach of GMM irrespective, to be future proofing themselves, because you see a lot of innovative products that's coming on through the panel discussion as well, right? You never know. You don't base on current products that you are underwriting now. There will be newer products which you will have to test and make it eligible from an auditor perspective, eligibility for PAA, right? So general insurers have different challenges in terms of proving that they are eligible, or to be more competitive, to be seen as more transparent companies, they try to adopt GMM method irrespective, right? So that's the type of challenge. Of course, I'm not going to talk much about reinsurers. We do have reinsurance customers who have adopted. For them, data availability is slightly delayed because they get the data or information after the main insurer puts a claim on them, right? So their data challenges are slightly different. Their cash flow model is also slightly different, right? And then in terms of multi-currency also, they have challenges because they will underwrite currencies. They will have underwrite contracts in multiple currencies. Not that Indian insurance companies are not underwriting, but they have challenges. Premium is in one currency, whereas claims could be in other currencies, right? So the cash flow matching with translation becomes slightly challenging for them as well, right? So different types of insurers face different challenges here, right? Now, so in terms of fulfillment cash flow, generally life insurers are ready, but I wouldn't say 100% ready, okay? From a CSM perspective, I don't think both insurers, life and non-life, will be ready with their existing systems. And reinsurance measurement, I'm just covering on the key ones. And last one, transition. How do you transit from your current to the future reporting system, right? Transition, there will be, as I said, 3 types of reporting even moving forward. Your tax reporting, plus your current reporting, plus your IFRS 17 reporting. And how many years of data are you going to transit? Are you going to do a full retrospective transition? Or are you going to adopt a fair value approach? Or are you going to adopt a modified retro? There are multiple methods that have been prescribed as well, right? In terms of transiting from a point in time. Preparing that transition data can be a challenge by itself, right? And all insurers normally face that challenge. So these are some of the practical challenges that we have seen. But to take this moving forward in a easier way, not to make it very daunting, right? I'm just summarizing 5 that we have noticed so far. Number 1, it takes time. It takes 10, 18 months. Not just for system implementation, but to get ready in terms of technical gap, in terms of vendor selection, in terms of implementation, putting together the team, because this requires actuarial, finance and IT team to be working together in one room, okay, or in the project, which itself is a big political challenge, right? But this is definitely required because disclosure reports drives what data needs to be collected. And when you want to streamline your management reporting, additional dimensions, not just prescribed by IFRS 17, but by your internal reporting may have to be added. Maybe you want a branch to be included. Maybe you want a channel to be included in the IFRS 17 reporting, which is not required from mandatorily, but For integrating your management reporting and the financial reporting, you may have to have data in those dimensions as well, right? So the ability to extend is quite important. So it takes about 10-18 months, and if the compliance is going to be from April 2026, okay, I would say it's about time to at least start the journey and then move ahead. Otherwise, definitely you'll be rushing. And we have seen 2023 compliance countries like Singapore or Malaysia, we started the project in 2019, 2020. For Thailand, 2024, we started in 2022, okay, meaning the projects are already started in terms of implementation. So I would say in India, I mean, this is the right time, 2024, if you want to be ready for 2026, right, because a lot of steps are involved. So 18-20 months, 24 months also in some cases where complexity of the requirements are high. Now, the team has to be a combination, actuarial plus finance, there is no choice. And you cannot have a separate team to be created for IFRS 17 to be doing IFRS 17 reporting, because it requires knowledge of your current products, it requires knowledge of your current processes. So you have to take people from the current reporting, monthly, BAP, PD, all these quarterly reporting, to be participating in this project as well. And that is why I say it takes about 10-18 months. We expect 5-7 days in a month that can be spared by this team, finance, actuarial, and IT, to be focusing on this IFRS 17. Otherwise, there's no way you can complete it, right? You may think, it takes 3 months, 4 months to implement. Not really. If you are dedicated doing nothing else other than this IFRS 17, probably 3 or 4 months. And if your data is already ready, okay, which is not the case. If your requirements are very clear, which normally not the case, because you have to check back with your auditors as well in many points, right? So give it time, because the team has to be a combination. And not only that, you should look for something with workflow, because a lot of data that needs to be interoperated, right? Second point, eligibility and future proofing. We spoke about multiple new products that definitely will be innovative coming up. So don't decide based on your current stature, especially general insurers. So don't think that you are eligible for PAA and so it can be easy. Not really. You have to be on your toes, testing every year, beginning of the year, you can use that, okay? And then comparing the variance or the LFRC as per the building block method, GMM method, versus the PAA should be within a bandwidth, okay, so that you are eligible for PAA, so that it is not material. To be honest, it's not material, then the auditors will allow, right? So you have to be on your toes. So you have to have multiple scenarios, okay, to be comparing. And also, a lot of explanations would have to be done, because auditors wouldn't just accept your new reporting by just producing the reports. It has to be completely auditable and with debit credit entries, which is very, very important, so that the auditors would trust, right? Third point on precision paper. So a lot of insurers that I've seen, they say we are doing technical gap analysis, it will take 3-6 months for them to complete, and then we'll start the project of IFRS 17. Actually, I mean, based on my practical experience, nothing against those who are writing technical precision papers, but I'm saying these precision papers or gap papers are not going to give you the details that is required for implementing a solution. It only talks about interpreting the standard and what is applicable for you. But it doesn't say, for example, if there are 4 methods of discounting the cash flow, okay, where the revenue can be accreted at a very high level in year 1, whereas at a very low level in year 5, let's say, or year 20, versus what can be accreted very low in the beginning and can be accreted very high. So the yield curves can shift and the income can shift quite a lot. But the standard doesn't say about what curve you should be using. It is based on your entity, your way of, your pattern, etc. So your precision paper will not talk about those details, okay, and what cash flow types that needs to be created, They would just say expenses to be split between attributable and non-attributable. But let's go through the list of expenses and how do we split between attributable and non-attributable, and how do I split it into the portfolios or into the cohorts, let's say, okay, and what ratios to use or what pattern to use. It will not be discussed normally in these precision or gap papers. Only when you get into the the act, you will understand those things. So I would say, don't wait for the perfect precision paper, because there's no such thing as a perfect precision paper. They just give it to somebody. No. There will be a lot of back and forth, there will be a lot of questions unanswered, right? But keeping the auditors in the loop is the key. Of course, the other challenge is data definitely is not coming only from actuarial system, multiple systems. And not only that, since you would have implemented all these systems at different points in time, the granularity of the data is not going to be the same. I mean, some may have branch codes, some may have channel codes, some may have, the agent codes, but some may not have. But for IFRS 17, you do require data from contracts, policies, expenses, claims, as well as all the patterns and curves, sometimes departments, cost centers, because to split between the attributable, non-attributable, maybe the information is in the department or in the cost center, right? So you may have to ensure the data is coming from multiple sources and the granularity is going to be different, so you have to normalize the data. So you require a lot of normalization process, right, transformation process, which should be part of the IFRS 17 solution itself. That's quite important. And then you get into unit of account, then you get into all the computations. But generally when people talk about IFRS 17, they only talk about this part, which is just computation once the data is ready. But to get the data ready is a big challenge, right? Because it is going to be in multiple granularity. So this is another watch outs, irrespective of the type of insurance. And so you need to ensure that what gaps, data gaps doesn't mean data gaps as per from a technical position, but data that is not available for computation. How do you treat them? Can you use a proxy or a representative way of splitting the data if, let's say, the data is not available, okay? If you have to split it into cohorts, or if you have to split it into groups of contracts, right? So, and then sign-off controls definitely is important because multiple users are going to be involved. Last but not least, in this process, when somebody says, the solution can do a lot of other reporting, synchronization, standardization, and harmonization, you will end up having a monster application because you will have data, or let's say, let's compute the CSM at policy level, okay? Which is absolutely not required because you have to do it only the groups of policy. But in the interest of, okay, let's do it at the most granular level, okay? Then you start over-engineering. What happens is, technically it should be possible. If it is millions or even if it is hundreds of millions, technically it should be possible. But the turnaround time that you require is more important, right? So you have to do a trade-off of at the end of every month or at the end of every quarter, I guess it's month, right? At the end of every month, how much time is given for changing an assumption to see how the results are going to change? If you want that agility, then you have to make your application slightly thin. But you cannot compromise on the thinness of application when you are trying to streamline your management reporting and your financial reporting. So you have to do a lot of trade-offs. Again, I go back to the 10 to 18 months implementation to consider these things. Don't look at it only from one single point of view. You have to look at it from multiple points of view, right? And so flexibility definitely is required, okay? And also proven 17 implementation experience is definitely required. You should not look at it as another financial reporting application, right? So these are some of the inferences, I would say, based on past experience. I'm already running out of time, but the thing is, we have a solution which computes all the three measurement models, including the data preparation, including the disclosures that are available in the system, including complete process control from data load up until exporting back to your GL system, which is quite important because you will have your existing GL system or financial reporting system in GL where you may have non-insurance data and other reporting already in. So many of our customers, they say, okay, compute all the IFRS 17 in the subledger, give me all the entries, push it back into your GL system, okay, so that we are able to do a complete reporting in the GL. Or it can be other way as well. We can pull all the data from GL system, okay, and do a complete reporting as well. So the choice is yours. So if you want a more detailed presentation, we definitely can walk you through, or to your concerned departments in your organizations who are interested in this IFRS 17 reporting, right? So I'm not going to go into all these details, okay? One important thing is cash flow. Cash flow. Organizations are at multiple maturity levels when it comes to cash flow. Some of them have got projected cash flows already available in actual systems at the unit of account level or cohort level, okay? Which is very rare in my experience. Even life insurance companies are able to provide only 60-70% of the cash flows. They don't provide reinsurance cash flows. They don't provide specific products that has been introduced recently, which is not introduced in their actual system yet, right? So there will be a lot of combinations. So cash flows, look for a system which is able to have a flexibility whether you provide the cash flows yourself, or can it compute the cash flows based on the patterns that is being provided, or can it take a combination of that? Some products you provide the cash flow, some products you don't provide the cash flow, you expect the system to compute the cash flow, right? So this combination would have to be there, which is relevant. And in terms of disclosure reports, etc., the flexibility of extending it to your PDs or into your BAP reporting should also be available. So net, end-to-end, not just think of only IFRS 17 as a CSM engine. Data preparation is important, and also the eligibility testing from a general insurance perspective is also important. So think of it from an end-to-end perspective, and also harmonize the data between your actuarial plus your GL plus your other reporting or Excel, where data is available in Excel. Okay, and then flexibility is key, because you will underwrite newer products which you think you don't have such products as of now, but definitely there will be changes. So have the flexibility to adapt. Okay, that's quite important. So I would say, based on this, if you want a further presentation, definitely we are there to help. Okay, I just thought I can share some high-level information first to understand what it is and what challenges and what are the best practices, what to watch out for. Right? Additional information, you can always reach out to me or Nishant, who is outside. You can see our booth by name Wolters Kluwer. Right? Please do visit us. Any questions?
Any questions, ladies and gentlemen?
Thank you, Mr. Mahadevan, for the very insightful session. My name is Umesh. I'm from Swissre. I'm a non-finance, non-actuarial person. So would want to understand, what I understand is very complex compared to the traditional financial reporting. So what are the benefits of IFRS compared to the traditional reporting that we have been doing?
So, I mean, this question comes up because this is like, oh my God, another additional reporting, not from IRDA, but probably from, IFRS kind of an angle. Actually, the benefits are from a shareholder's perspective, where if you have to compare one insurance company's performance against another, it becomes really very tough these days, because everybody has their own assumptions and risk factors. Comparability within the insurance company itself is a challenge, let alone comparing an insurance company against another industries, right? So that benefit will be there now with this, because you are basically recognizing, it's just about recognizing the income. I mean, from an accountant perspective, recognizing the income, future income, based on some risk and parameters, discounting it from an interest rate perspective, currency rate perspective, and then getting it as an income that is recognizable for the year, plus also creating a liability, set aside a reserve that is going to reasonably match the future expected claims, let us say. So from a layman's angle, it's just about transparency and comparability against different industries, right? That's number one. Number two, internally also, compensations and performance initiatives internally for promoting internal staff, right? I mean, it becomes a black box these days in the insurance company. So from an employee perspective as well, the performance becomes much more open and transparent and predictable. I mean, I wouldn't say predictable, but at least more transparent, okay? So that's the second benefit. Of course, from a systems and process perspective, streamlining this will definitely benefit from a longer term introduction of a new product or introduction of a new process, etc., because you are streamlining the way how you're going to compute the income and the liability using patterns and curves, okay, using predicted cash flows. The process is the same, right? So from that perspective, it definitely benefits, right? So comparability against different industries and more transparency, okay, and also from a system streamlining perspective, reporting streamlining perspective. I'm sure this will last, even those countries where they've mandated since 2023, okay, they haven't come to one unified reporting. Tax reporting is still there. There is existing financial reporting and this IFRS 17 reporting. That has not changed yet. So it is not going to quickly change in India, I would say. I mean, even if it's 26, probably another 2-3 years later. Because even the tax authorities are looking at, if you just change the way that the income is recognized, probably it's going to reduce the tax. I mean, I'm sure there are no, okay. So they will also watch out first to see, is there a big difference in the recognition of the net income, right? So until it all boils down to one unifying point. I wouldn't say exact point, but at least polarizes towards one point. This 3 reporting will continue for at least 3 to 5 years. Okay? And you have to have some mechanism of reconciling. This is a challenge of the benefit that you're looking at. Okay? But it's all being looked at it from a global angle. Yeah. Yes.
Can I have a follow-up question?
See, one thing which you mentioned, I'm from a non-finance background, but, from the industry. So one thing you said now, we'll be able to compare things, across, within the industry, to starting point. But then, within that, you mentioned that, there's so many ways to calculate the present value, and, you talked about the yield curve, how it can change. But so isn't there something, while any companies which adopt that, there has to be some standard way, and then they can also choose their own way. Because still, while companies are adapting this, there would be so many ways of calculating the PV, which will, the valuation will not be comparable.
You're right. There are some parameters that are adaptable by individual companies. If it is accretion of income over a period of 50 years, and some companies may adopt a curve that has more income to be recognized in the early years than the later, or vice versa, right? So there are some adaptability chances for the individual entities to differentiate themselves, but it all sits within 2 or 3 curves, 2 or 3 ways of doing it, right? And auditors definitely will have a play in this to determine whether what you're doing is the right way of doing, representing your business, because the way that you underwrite, the seasonality of your business, etc., will also be considered when you consider these discounting curves and patterns, right? So yes, you're right. There will be some possibility of differentiation, but the overall is going to be within the guidelines. Okay, so auditors will definitely play a role there. You have time?
We can just take one question,
Okay.
the last. Can we have a mic over there, please?
Just a quick question. Sorry.
Okay.
So, quick question.
Who spoke? Oh, I'm sorry.
No, he can ask.
Okay, yeah.
So I lost the thought. Please go ahead.
So, Maha, I have a question around,
Okay.
Once you implement the system, definitely the experience is there. And we know the curve of learning for auditors or even the accountants currently in India is not to the mark. How do you see, and you must be facing these challenges, that the auditors comes afterward once we implemented some systems and auditors woke up that this should have not happened. This should be in this way.
Okay. Yeah, so I mean, if it happens after the fact, let's say after 10 months of implementation, you come up with the results and the auditors comes and say, no, go back, okay? That is, yes, a challenge. That is why in the early stages of the project, in the design phase itself, we ensure that some of the decisions, key decisions that is going to impact the way things are going to be recognized, okay? Example, probability of default, should it be considered or not, or amortization, do we have to do the amortization this way or another way? These are decisions that we document during the design session itself and ensure auditors are you have to sign off on the design anyway, right? And we normally recommend you, please run it by the auditors, okay? We will also sit with you to run it by the auditors to say, hey, this is how it is going to look like if you're okay in principle. I mean, the data is not yet done, right? And we will also do the same thing when there is a UAT phase, to ensure that there's some reasonability with 1 or 2 portfolios to ensure that this is reasonable. And also in the transition stage, because before you go live, you transit, right? Even in that transition stage, you have to ensure that there is some reasonability checks that are being done, right? So there will be multiple points in which we will ask you to do a reasonability check, okay? I mean, not calculation accuracy, but reasonability, okay? In terms of the assumptions, is it making sense for your industry, or not for your company, okay? Yes. Has to be done. You have to keep the auditors in loop.
So last question. So
Yes.
I just remembered. Okay, so for the future revenue, do you use a forecasting model, or how do you basically?
No, this is not a. This is based on your current policies where the premium is going to be oozing out across multiple years, right? And then projecting that cash flow in terms of when they're going to pay. Some are beginning of the month, end of the month, beginning of the quarter, end of the year, annual, biannual, quarterly. So you have a projected cash flow of the premiums, which of course we take normally from the actuarial systems where you already have some kind of an assumption of the policies and the the frequency of payment of those policies. So it's cash flow, right? So it is based on the actual contracts that you have and the premium payment pattern of the set of contracts. That is for existing. For new business, of course, for new business, you don't have to take the IFRS because it's not yet happened, right? Because it is just in air. You may get business, the contracts are not yet signed. So we only worry about the contracts that are already in place and which has got, 5 years or 10 years, 20 years of revenue that is coming up and the expected claims that you have on those policies and then the expenses that you expect to incur, not just claims, but other expenses. So all these are being factored to compute the income and the liability, right? It's not about now, this data, your question is valid, this data can be used for doing your planning and forecasting because a lot of, so I'm sure you have existing business and new business, right? The existing business data is already available in the system now. The existing business, not as of today, but also for future 30, 40 years, cash flow is available, which can be used as a starting point for your planning purposes. Okay? And then, that is why we extend our system after the IFRS 17 into planning budgeting as well. But the problem is, as of now, your planning budgeting process probably is on IFRS 4 method. You probably are not ready with the IFRS 17 method of planning and budgeting, right? So once you implement 17, probably in the next 2 years' time, you should think of synchronizing this with your planning and budgeting forecasting process also, where existing business projections are available in 17. New business is something that, the business owners will predict what business they're going to bring in, right, on the planning and budgeting process. That needs to be married for internal management reporting purposes.
Okay, thank you.
Thank you very much. Thanks for the interactive section. I hope it was useful.